First and foremost, welcome everyone to the 2022 Economic Forecast. We're pleased to once again be able to have Chris Thornburg here to give us his take on what's happening, what happened in 2021, as well as his thoughts on 2022. Of course, I wish this could have been something we do in person, and we look forward to seeing our clients, colleagues, etc. Unfortunately, circumstances really didn't allow for that this year. So we've got this kind of unique kind of scenario, if you will. But rest assured, for any of you that are watching this or any of you that can't make it, we'll be sending out a PDF link here in the next couple of days with everything. And I'm sure Chris will probably give us some great advice. Looking forward to hearing what he has to say as far as what we should be investing in 2022, as well as what his thoughts are as far as Southern California and real estate in particular. With that, I'll turn it over to Mr. Chris Thornburg. Thank you very much.
All right, thank you very much. Appreciate that. This is a little bit of an odd setting after, I think the last time we did this was in 2020 over Big Canyon, which of course is a lot nicer setting with a lot better drinks. But I'm glad to be here, and there is a lot to talk about, there's no doubt about it. What we're going to do today is I'm going to talk, kind of do my standard spiel. I got too many slides as always. We're going to buzz through them, talk a little about the economy. And at the end of that, we'll do a little Q&A. As noted, we'll be doing a record on this for those of you who are watching digitally. In fact, you may be watching this after this talk is done. And we will make a PDF available so you can flip through these slides as well. Let's just start with two numbers. Q3 GDP, we haven't gotten Q4 just yet. But Q3 was 2%. December's unemployment rate is 3.9%. If I looked at this in any normal year, I would say, it's perfectly reasonable. Labor market's a little tight, but the economy's growing. Things are absolutely fine. But of course, the New York Times is busy telling us that the economy's in rough shape. And this is the world we live in. We have stories about where the economy is, narratives about where the economy is, and then we have data and numbers that tell us a completely different story. Now, what's going on? What does this attitude mean for policymaking? And perhaps more importantly, what does policymaking mean for the direction of the economy, particularly as, of course, it relates to commercial real estate? I will tell you now that there aren't a lot of easy answers. We live in very strange times, to say the least, but that's nothing new. The narratives, the incorrect narratives, narratives that have been out of touch, if you will, with reality, have been with us for a while. And in a very real sense, these reasons are at the bottom of why we're in such a strange place right now. So with all that in mind, what's the big picture? Big picture. First and foremost, look, there's no doubt that COVID has been a tragic natural disaster. Millions of people have lost their lives. Millions of families are suffering from that. But with that in mind, the data on this is pretty clear. As tragic as natural disasters are for people, they don't have long-run consequences for the economy. In other words, had the U.S. government done very little, this would have been a rapid recovery regardless. But of course, that wasn't the conversation. The narrative about our economy coming into the pandemic was an economy that was on its last legs. We were constantly being told about the recession that actually didn't happen. We've been fed stories about how a large portion of Americans are starving on their feet, living hand to mouth, again, with almost no evidence. But this narrative drove D.C. to one of the most greatest outpourings of fiscal and monetary policy you can possibly imagine. $11 trillion and counting. I mean, that's the thing. They have backed off what I would call some of the big pushes, but the stimulus is still there. You look at the Fed balance sheet, it continues to grow. You look at the federal deficit, it's still enormous. They are still pumping money into this economy. And in a very real sense, the economy is completely overheated. And that's the most dangerous dichotomy we face. We have policymakers who aren't willing to acknowledge that the pandemic economic crisis is far beyond us. They are still in that mode of saving the world from whatever they think they're saving it from. Whereas all the data tells us the economy is incredibly overheated, which of course for the next couple of years is fine. We're all going to prosper over the next couple of years because the economy is so overheated. But at some point, the bubble pops, and then what? And that's the big question we're facing. Now, it isn't an even recovery. It's a strange recovery. Only thing you have to do is look at the ports and how crowded they are and how there aren't cars to be sold out there right now. And you realize things are not normal. We hear about supply chain problems all the time. The supply chain problems are being driven by a number of factors, not the least of which is the economy's come roaring back in ways that no one had anticipated and wasn't prepared to deal with. But putting out to one side, it's kind of a non-story. If anything, the supply chain problems we're seeing today is maybe slowing the economy down just a little bit, which may not be a bad thing given how overheated everything is. But there's nothing to be particularly worried about on that front. The real worry we face today, again, comes from excessive stimulus and the problems of excessive stimulus. And let me put this a little bit in context. Back in 2006, when I started Beacon Economics, one of my first big calls was the unsustainability of the real estate situation. And I was worried about where the global economy is going in the back end of that. As it turned out, by 2008-9, we realized that my views were correct. And of course, we ended up with the Great Recession, which was the worst downturn in the post-World War II period. This time around, we are facing a similar level of risk. But the source of that risk has completely switched. Back then, the public sector was fine. Monetary policy was fine. Fiscal deficit was manageable. It was the private sector that was a disaster. It was the diminishment in quality of debt, the huge increase in consumer debt, the unsustainability of the lending going on in real estate, commercial and residential. It was the private sector that was scary. This time around, I look at the private sector, and actually, in a lot of ways, American households today are financially as well off as they have ever been, in part because of the excessive amount of stimulus. But then you turn around and you look at the public parts of the economy, namely, of course, the Fed balance sheet, which is pushing inflation, and then enormous federal deficit, which is clearly unsustainable. And you realize the risks today are just as profound as they were back then, but coming from a completely different part of the economy. Now, with that in mind, the real question is how does this thing shake out? How far does it go? The answer is, and I mean this quite sincerely, I have no idea. I really don't. This is not a simple situation to explain. I'm still figuring out myself, and my job is to do this stuff. What I do know is the risks are enormous, and people don't seem to be paying much attention to them. And that is when scary things happen. Again, not for the next couple of years. There's too much momentum in this economy for the next couple of years to be derailed. But there is a stopping point out there at some point in time. And how far this goes will determine what that stopping point looks like. We're going to come back to that. As for a long-run standpoint, a couple things here to keep in mind. First of all, I want to talk about labor markets. Obviously, the great resignation that's going through the United States right now here in California is having a big impact on a lot of businesses. Just getting phone calls from folks going, hey, I'm thinking about building some industrial in X, Y, and Z location. And I'm just wondering, in 3 years when I finish this project, will there be anybody to hire? These are very real questions. And yes, they are things we have to discuss. They're going to have big impacts on labor markets, on inequality, on what we call economic development policies. These are big deals. And by the way, it's not a temporary circumstance. When COVID goes away, the people aren't coming back to work. And then, of course, last but not least, we have to talk about the new normals. Now, to be clear, what I learned over the last 2 years is anytime a reporter used the term new normal to describe the pandemic, I immediately stopped reading because this person was an idiot. Pandemics, epidemics have been with humanity since the dawn of civilization. There is no new there, and human beings have, in the past, persevered. No one's ever gone to live in a cave for the rest of their lives because of a pandemic, and I don't think it's going to happen this time. But there's no doubt that the pandemic has accelerated, tremendously accelerated, underlying changes that are already in place in our economy. Changes, by the way, have a profound impact on the need for commercial real estate. whether we're talking about work from home or buying stuff online, or even the fact that all these people are retiring, leading to labor shortages. All these things were already in place, but we were kind of ignoring them. Well, they all got accelerated, and now the world post-pandemic is going to feel a lot different than pre-pandemic because of these changes. But remember, they were already there. This just accelerated them. And again, thinking about the long term, you got to start paying attention to what these new, so we say, fundamentals in commercial real estate space are. And we're going to come back to that as well. So there's too much to talk about. I got like an hour or so to talk. I know we're going to do a little Q&A. I believe people are going to be able to ask questions online. So if you're online, you'll be able to get some questions in the chat box, and they will be read off, and we'll be able to answer those. And if you're listening to this after the fact, sorry, you don't get to ask questions. You should have been here for the live event. So with all that in mind, let's just jump right in. I will start out with my wall of forecast shame. 2 years ago, in January of 20, I was running around on a bit of a victory tour because in the beginning of 19, 80% of economists who contributed to the Wall Street Journal said we were going to have a recession by the end of 2020. 80% of them did. Now, I didn't buy any of that. All the things they were worried about, I didn't think were significant enough to offset the expansion. And of course, by the beginning of 2020, the number of economists who said we were going to have a recession by the end of the year went from about 80% down to about 9%, which is 9% of economists always say there's going to be a recession the next year. That's just how it works. Now, of course, irony of ironies, within 2 months, we were thrust into one of the deepest downturns this nation had ever seen, of course, driven by a pandemic. At the beginning of 2019, no one ever heard of COVID. They weren't discussing this. But of course, ultimately, those folks ended up being right. Now, what happened? Well, this happened. This thing hit, and yes, there was a lot of uncertainty. It was a new kind of circumstance, but these headlines were absolutely nuts. I mean, a J.P. Morgan, economy is going to contract by 40%. Worst economic downturn since the Great Depression. Scar labor market for a decade. Here's a fun one. 30 to 40 million people are going to be evicted. By the way, this has turned out to be 3 to 4 people have been evicted. 30% of people are going to stop paying, right? Or for my former colleagues at UCLA, make no mistake, this has turned into a depression-like crisis. I mean, wow, right? I mean, how horrible this is. Yet this is exactly what, of course, policymakers were seeing at the beginning of this thing. And no one had any context. Remember, there's nothing new here. If it wasn't this, it was the recession that didn't happen, or the terrible expansion, or all the terrible things that were going on. Miserableism. Remember, that's the word I've been using over the last couple of years when I've been in person in a big country. Miserableism, this constant need to tell us how terrible everything is. Now, of course, none of this was the real deal. And, let's just jump right into debate number one, the U versus V debate, right? Now, most folks said a U-shaped downturn. And as I say, we're going to hit bottom and we're going to be there for a while. It was going to be a slow recovery, a long, painful period of time, the U situation. Now, the real clever economists, by the way, didn't stop with U's. Some of them said it was going to be a square root sign. Some had the, I don't know what, they had all sorts of symbols, right? W's, there was a W, folks. My favorite pessimist called it the L-shaped recovery. We're going to hit bottom and never grow again. Really? You're a hell of a good economist. Crazy, right? But anything to get your name in the paper. What has happened? Well, I think the V looks pretty clear there, right? Big bounce by the third quarter of last year, enormous bounce back. And, it's interesting because you come into the end of 2021, and yes, GDP slowed down a bit, and some folks were still panicking about it. Why? Well, output's still 2% below long-run trend. This is a terrible problem. Well, is it? Look, when you think about a downturn and a recession, you say the government needs to do something about this. You need to lower interest rates. You need to do fiscal stimulus, a la Keynes, and so on and so forth. Why? Well, we worry about the impact of business cycles on people. I can't feed my family. I can't get a job. I'm going to lose my home. I'm not consuming enough, right? So let's not worry about GDP, and let's actually talk about something more realistic, like, for example, final demand. Final demand, by the way, is consumption of businesses, consumers, and government all put together. By the way, final demand got back to long-run trend as the second quarter of last year. And the third quarter, it just stayed on that long-run trend. In other words, at least from a consumption standpoint, this recession has been completely erased. It's already gone. Now, how can consumption catch up and not production? Well, we're getting it from someplace else is the answer. And really in two places we're getting it. One is we're consuming everything in sight in the United States. Inventories are going way down. You can consume stuff that was made a couple of years ago in the form of inventories, or equivalently, you can get it from the rest of the world in the form of course, of a trade deficit. And that's another place where you've seen this, an enormous widening of the trade deficit. So consumption's back, but that consumption is not being met by U.S. production. Rather, it's being met by foreign production and or U.S. inventories. That's what's going on right now. But again, we're consuming a lot. There's no doubt about it. Why was this not a great recession? Why did the economy bounce back? Well, a couple reasons. First of all, we all understand that when a shock hits the system, whether it's a collapsing real estate bubble or a big pandemic, well, the economy is going to have to take a bit of a hit. It's got to work through those problems. Now, how well the economy can work through that problem depends at some level by how well people are prepared to deal with any kind of economic problems. For example, coming into the Great Recession, we got the big hit from the collapsing real estate market and the problems in the banking system. I get all that. But it wasn't just that. It was the fact that people have been incredibly over-consuming and over-borrowing in the years ahead of time, which meant any kind of problem in their life was quickly going to cascade into some sort of massive crisis for their family, which is exactly what went on. This time around, while the economy wasn't, shall we say, growing in any spectacular fashion, actually the fundamentals of the U.S. economy were in really good shape when the pandemic showed up. Savings rate were at 30-year high levels. The financial obligation ratio was quite low. Actual debt-to-income ratios at every level of income in the United States was in pretty good shape. The labor markets were super tight. In other words, we could handle some problems without having much of an issue. So we were in a different kind of position to handle a shock. Even more important than that had to do a lot with the recession driver. Again, when you go through the Great Recession, you say, we know we had the big problems in consumer finance, the big problems in real estate, but the problem that really created one of the slowest recoveries we've seen, which meant that full Great Recession business cycle was close to 9 years by the time we actually fully recovered. Well, the reason that was so long-term and so painful had to do with the balance sheet problem. It was a demand shock. And what do I mean by that? Well, look, everybody in 2007 felt rich, right? You can borrow as much money. My home's worth tons of money. My stock is worth tons of money. And, you know, the world is nothing but up, up, up. I'm just going to keep borrowing and keep spending, and life is good. Well, when suddenly the bubble popped and your home value went down, you could no longer borrow money, your stock portfolio went down, you suddenly realize, I have a lot of debt and I don't have a lot of wealth. And I have to save for juniors' college education and so on and so forth. What do? You save. And that's that whole Keynesian sort of savings trap we used to talk about. That was the big problem, because everybody's saving, trying to refair their balance sheet, and because everybody's saving, nobody's spending. Because nobody's spending, nobody's hiring. Because nobody's hiring, people can't fix their balance sheets. So we ended up in this ugly cyclical situation that took years to work out of. Again, this was not a demand shock. It was a completely different kind of recession. It was a supply shock. Now, what's the difference between a demand shock and a supply shock? It's very simple. This is the best way I can describe it. In 2010, people didn't go to restaurants because you couldn't afford to. In 2020, you didn't go to restaurants because you weren't allowed to. That's huge. Why? Because we're good Americans. If you can't spend your money on restaurants, you're damn well going to spend it on something else. And they did. You know, if anybody tried to buy a bicycle or a boat or a hot tub or anything at the end of 2020, there was nothing there. Those shelves were emptied. And that's the key. It wasn't a general hit to the economy. What we never heard about in the paper, we all heard about the closed restaurants and the hotels struggling. What we never heard about was that Home Depot had record profits and they couldn't hire enough people. We never heard about the bike shops that had no inventory because they were selling things so quickly. We never heard about people making money in the middle of the pandemic, which offset a lot of the pain. Simple as that. And then, of course, last but not least, government response because of politics, inadequate after the Great Recession. They didn't do enough, particularly Congress. The Federal Reserve did exactly what they needed to do. Congress completely fell down the job. And then, of course, this time around, we also had a problem. This time, Congress went crazy for political reasons. This time around, by the way, the Federal Reserve also went crazy. Because there's a big difference between the Federal Reserve of 2006 and the Federal Reserve of 2020. In 2006, the Federal Reserve was still run by people who were qualified to run the Federal Reserve. By 2020, it was being run by a guy named Jerome Powell, who was a politician, not an economist. And he just sucked up the same nonsensical rhetoric that everybody else in D.C. was drinking, whatever nonsense it was, and he proceeded accordingly. And again, it's wonderful in the short run. This economy is on fire, but we're creating incredibly dangerous circumstances when you look down the pike just a little bit. Now, again, the bounce back has been odd. It's been uneven. It's not been normal. You can still find places of pain in the U.S. economy. There's no doubt about it. But again, other places, there's plenty of prosperity. Take, for example, just the breakdown in spending. This is basically real consumer spending, durables, non-durable services relative to the long-run trend. Services took a big hit, still not back to where it was pre-pandemic. Hotels still aren't running up for 100%. In Anaheim, still not doing the big conferences they used to do. So on and so forth. Some restaurants haven't been able to reopen. Recreation is still down. However, spending on goods, durables and non-durables, not only has recovered, but it's above trend. At one point in time, spending on durables was 25% above trend. It's still almost 8% above trend. So spending on goods is way above normal. Not just way above where we were, it's way above normal. That's one of the reasons why we can't keep stores stocked, why there's not enough cars out there to buy, because this level of demand was never built into the system. As simple as that. And of course, we see the big problems in the ports. So anything you have to do is wander over by, get on one of the hills around the ports of LA and Long Beach. You can still see a bunch of the boats out there stacked up. And there's a really quick cascade problem. Remember, we have a very fine-honed global supply system. So what that means is if a boat gets stuck out of Long Beach and Los Angeles for 2 weeks, it isn't just our supply chain we're screwing up. It's the entire global supply chain that's getting screwed up. And of course, it's just been a mad scramble trying to figure it out. Now, where there's a profit, there's a way, and I'm not worried about producers. They will find a way to meet this demand eventually. And in the meantime, if you can't buy that BMW M-Class in the exact color you want, get over yourself. You'll figure it out. Your life will go on. This isn't really a big issue. But do feel sorry for the auto industry, by the way. Look at the decline in auto sales. If you show me this picture, this is a nasty recession. No, actually right now, it's because there are no cars out there. It's as simple as that. And it's not just that they were unprepared for the demand for cars. It's that for the last couple of years, they bought into the idea that the U.S. economy was any minute going to have a big recession. And they started pulling back on inventories of automobiles in 2017. That's when they started cutting inventories. Of course, when 2020 hit, they all went, aren't we smart, right? We got rid of those inventories. We're going to be able to weather this storm. Next thing you know, everybody and their brother wants a car, and there are none available to buy. It's simple as that, which is why the price of used cars is going through the roof right now. Again, eventually the auto industry will catch up. I know they will. I'm not worried about them, but it is an interesting circumstance to find ourselves in. As for the service sector, it's bouncing back as of the third quarter. Recreation, transportation still down. This is basically conferences, global tourism, and of course airplanes, which still aren't back. But other stuff is starting to bounce back. Healthcare is getting back to normal. Even food and accommodations is almost back to where it was in real terms pre-pandemic. Airlines are starting to ramp up again. Hotels are doing much better this year than they did the previous year. And by the way, even hotels that were not near airports did great through the pandemic. This goes back to the winner-loser thing, right? Yeah, the hotels around Disneyland did horrible. Did anybody try to get a room in Palm Springs in, winter of 2020? They were a mob scene. Went through the roof because anybody who could, people just wanted to drive just to get out of the house. Just let me get out of here. Filming in LA started catching up. Again, good news there. As for Omicron, we're all in the middle of that right now. That's why we're not doing the event, right? Omicron, it's ripping through. We got to worry about that one. The numbers are pretty astonishing when you look how high they are. Now, mind you, we haven't seen it in deaths. Hospitalization's going up. But even here, you got to be careful. Turns out right now, I don't know. I heard this the other day. I'd have to see it verified. But according to what I heard, something on the order of 35 to 45% of quote-unquote people in the hospital with COVID went to the hospital for something else and found out they had COVID. It wasn't that they got COVID and went to the hospital. It's like they're testing everybody, and people are showing up and going, oh, I broke my arm, and I have COVID, as it turns out. Well, okay. So it's, again, it's not that serious. And, is it going to have a big impact on the economy? Let Vegas tell you, all right? I was in Vegas prior to the holidays. Even without global tourism, even without the plane full of Chinese showing up, they hit record high gaming revenues in Vegas over the course of the last couple of months, even in the middle of Omicron. I like to say there's two kinds of Americans. You're vaccinated and you don't care, or you're unvaccinated, just proving you don't care.
Either way, you don't care.
We don't care, exactly. Can we just move on and not argue about it, okay? You made your choice, let's move on. No, this is not important. Now, why is the economy so on fire? Just look at these numbers. This is net federal borrowing as a percent of GDP, and we've never seen anything like this. I mean, this is off the charts, the kind of borrowing going on. And even coming into the third quarter, when quote unquote the stimulus efforts are done, you're still seeing federal deficits 7, 8, 9% of GDP. I mean, these numbers are incredible. And what are they borrowing the money to do? What are they spending it on? Well, the answer is anything and everything. They're giving money out to local governments. My company, I get calls from local governments going, yeah, I got $80 million. I have no idea what to do with this money. Bizarre. But everybody's awash with money. And the money they gave people through the stimulus checks, the unemployment, the PPP loans, insane. How much? Well, this purple line here. This is data on household income, personal income, relative to trend. Yellow line is spending. The orange line is incomes, disposable incomes, getting rid of government benefits. And the purple line here, or blue line, whatever it is government spending, government benefits, which includes unemployment, PPP loans, whatever the case may be. They've given us $2.1 trillion in direct stimulus, direct aid, to offset $820 billion of income hits. So, in other words, for every dollar of lost income, the government has given back households $2.60. For every dollar of lost income, they've given people back $2.60. Like, what are you doing? How, right? How can you justify this? And it's not just them. Again, Jerome Powell jumps in. Ben Bernanke, Janet Yellen took 6 years in the midst of one of the greatest financial crises this nation has ever seen to do a little over $3 trillion in quantitative easing. Jerome Powell did $4 trillion over lunch. Interest rates are way down. Why? We'll come back to that. Now, the boondoggle is pretty apparent. For example, cumulative personal savings, by the numbers I'm seeing, relative to what people would have saved anyway, about $2.5 trillion in excess household savings. Just flat out what I didn't spend, $2.5 trillion. Commercial bank deposits, $3 trillion above trend at this particular point in time. People are awash with cash. And you see it. You're in the commercial space. You know this. Everybody has money. There is so much money floating around. And of course, people got to do something with it. So they're throwing it in investments, and the financial markets are going absolutely nuts. We all know about the stock market, second highest PE ratio in history, way above 1929. We're starting to get close to where we were in 2000 prior to the big tech bust. It's not just that. Venture capital investments. Look at the numbers here. In 2019, there was $100 billion of venture capital investments in the United States. In 2021, it was about $230 billion. Off the charts. People have more money they know what to do with. How about Bitcoin? Now, listen, Bitcoin's $45,000. Now, we've done some work on Bitcoin. We've done some work. I've sat down, I've run my models. It's technical, it's complicated, but my models tell me the fundamental value of Bitcoin is 0. To be clear. And I think 45,000 is a little overpriced. Just saying, okay? It's amazing. I mean, by the way, this is interesting in its own right. People are going to write books about cryptocurrency in a few years. And they're not going to be pleasant ending books, okay? This is not a new world order This is one of the greatest Ponzi schemes we've ever seen in the history of the globe. And I'm not talking Ponzi schemes like, oh, Beanie Babies. I'm talking Ponzi schemes like what was going on with the Mississippi bubble back that brought down the King of France in the 1700s, or the South Sea bubble. I'm talking like economy shattering type bubble that's forming out there right now. I mean, that company just renamed Staples Center, what is it, Crypto.com? I mean, when companies from Singapore are making so much money as to rename Staples Center, this is a big deal. It's a big deal. By the way, regulators, deer in the headlights. They have no idea what to do with this. They are completely, the only country in the world that actually knows what it's doing with cryptocurrency is, God help me for saying this out loud, the Chinese. They're like, no. And by the way, that's exactly what Americans should be doing. No, not doing it. You want to do offshore accounts on your own time, fine, but you are not trading that crap in this country, period. But again, we'll see. We'll see. Now, with financial markets going crazy, again, it's way more than the couple $1 trillion in excess savings. Take a look at this number here. This is annualized 2-year growth rate in real household net worth. And we are seeing one of the greatest expansions of real household net worth we've ever seen in the United States. Over the last 2 years, because of all the savings, because of home prices going up, because stock market going up, because of everything that's going on, Americans have picked up something on the order of $29 trillion in new household net worth. $29 trillion. Annual output in the United States is $24 trillion. So we're talking an entire year of output in wealth generated in this scenario. And it's not just the new cash, it's also their incredibly low interest payments. Look, this is the financial obligations ratio. It's the share of household income spent on financial obligations. Prior to the pandemic, it was already down to about 15%. Now everybody's refied their house, and that has dropped to 13%. We're as rich as we've ever been, all based on just $11 trillion of new money and new debt, government debt. It's not sustainable. It's just not sustainable. But of course, in the short run, not a big surprise that share of consumer debt and serious delinquency is plummeting. It's not, by the way, just the ultra rich doing fine. Look at new personal bankruptcies. Personal bankruptcies pretty much happen to lower income families. And you can see how they've dropped tremendously over the course of the last year and a half. No major issues here at all. Bank lending just starting to pick up now. But, you know, the big problem with banks, look at the gap between assets and deposits in the banking system right now. It's going to be an interesting world. The banking system is a whole other thing you've got to pay attention to, because they're not paying attention to, wow, my interest rate risk. They're paying attention to the fact that I have way too much cash and I can't do anything with it. If you're borrowing, great time. If you're invested in a bank, you might want to pay a little attention to what your bank board of directors is thinking right now. Because, again, where does this go? I don't know. Now, with all this good news, where are the damn jobs, right? Adding a couple 100,000, a little less than that. We're 4 million jobs off from where we were. Some sectors, leisure and hospitality, short 1.2 million jobs in the U.S. Where are the jobs? Well, before we start worrying about where are the jobs, maybe we need to change the question just a little bit. Look, people are freaking out because we have fewer jobs now than we did a couple of years ago, because typically after a recession we have fewer jobs than we did before, because we have a problem with labor demand. We have fewer jobs in 2011 than we did in 2007 because there was less labor demand. Not complicated. But that's not the only reason. You could have fewer jobs because of less labor supply. Could be either one. Isn't necessarily one or the other. Now again, most business cycles, it's labor demand that's driving the show. Not this time. You take a look at the unemployment rate, which I haven't even updated this. It's now 3.9%. The unemployed to job opening, never been lower than it is right now. Job openings and quits through the roof. We've never seen anything like it, right? In Nevada, right? Nevada's got one of the highest unemployment rates in the nation right now. Look at the job openings in Nevada. MGM Holdings, you know, the MGM Entertainment, which has all the big MGM casinos, they have 50,000 employees in Las Vegas. 5,000 job openings. I'm not kidding you. 5,000 job openings. 5,000. That's why it takes an hour to get a cup of coffee in Vegas. There's no one to hire. Now, why? What happened here? Well, look, this was going to happen. We knew this, right? This is demographics. This is our population pyramid up to the boomers, and then our boomers so scarred by having 11 kids in the family, they all went out and had 1.1 kids, and our population pyramid turned into a population column. Now the boomers are retiring. We're not bringing people in to backfill at a sufficient pace. Indeed, if you look at the growth of people in 15 to 64, you can see for the longest time they were growing 1 to 1.5%, and then starting in the beginning of the century, decelerate, and coming into 2020, it actually went negative. So this was writing on the wall. We knew this was going to happen eventually. We knew labor shortages were coming, but we kind of weren't paying attention to it until the pandemic hit. What happened in the pandemic? This. The labor force dropped by 3 million. Now again, in the midst of all the chaos and all the things that were going on and all the stories you were reading, no one ever stopped and took a step back and said, this is not right. This is not ordinary. Even during the Great Recession, the worst downturn in the post-World War II period, we had a couple of years where the labor force was flat. And that was unusual. This, unprecedented. Now, there's all sorts of stories, right? Again, you pick up the paper. I love the stories, right? What do you got? People are afraid to go back to work. Oh, it's seniors being discriminated against by this labor market, or let me see, they have to stay home to take care of sick people. Or some journalist said, I think it's long COVID. Millions of people are suffering from long COVID and they can't work. Well, I got an idea. We have this thing called the Current Population Survey. Every month we survey 70,000 people and we ask them a question. If you're not in the labor force anymore, why? Well, they already told us the answer. They retired. 2.6 million people retired. They aren't disabled. They're not afraid. They're not discouraged. They retired. They said, I'm done. And, this probably shouldn't be much of a surprise. We had a lot of people who were on the edge of retirement, but they hadn't quite retired. It's a big step. Your boss was begging you to stay an extra year. He gave you a little bit of a raise, right? People kind of stuck around. But then everything shut down. It was a Great Depression, yet my stock portfolio is the biggest it's ever been. I just refined my house at 2.6%. What a great time to retire, and they did. Now, there's some upsides to this if you're not running a business. One of the upsides is if you're worried about income inequality, your solution has arrived. And this is the narratives. How many stories have you heard about income inequality in the last, 8 years of your life? Anyone? What's interesting about that is starting about 8 years ago, income inequality started going down. I know it sounds almost impossible to believe, but this is data from the Atlanta Fed wage tracker. This is earnings growth by quartile. And starting roughly about 2015, this is roughly when we recovered from the Great Recession and those labor shortages started kicking in, the earnings growth for people in the bottom quartile started growing faster than everybody else. And we are all told about this K-shaped recovery. Actually, it's the first recession in the last 50 years, since we have decent data, where not only did earnings growth not slow down at all for anybody, but the earnings for low-skilled people, low-paid people, actually started growing faster, even faster. So, yeah, if you're worried about income inequality, this is going to be good for you. If, on the other hand, you're worried about running a business, if you're trying to get your restaurant reopened, good luck to you, because there's no one out there. It just really is no one out there. Now, with that in mind, again, how does this pan out? I gave a talk to the folks. There's a new hotel and restaurant right in Culver City by the train line. I think it's a Hyatt, but it's called something else. I don't know if anybody's familiar with that in West LA. But I was giving this talk there and talking about labor shortages. This guy came up to me afterwards and he said, it was pretty interesting conversation. He goes, yeah, we didn't have any problem. I said, you didn't have any problem? No, he goes, my hotel's staffed up, my restaurant's staffed up. I mean, that's pretty good. How'd you do that? He goes, very simple. Anybody apply for a job, we offer them $3 more per hour than they had their last job. Well, there you go. That's it in a nutshell. Labor costs are going up. You got to deal with it. Simple as that. I don't care where you are, what you are. And by the way, this isn't going away because these people have retired. It's not like COVID's going to go away and people are going to go back to work. So labor shortage is a whole conversation which every local development person needs to come to grips with. Because the old economic development mantra was jobs, jobs, jobs. Bring the jobs and everything else will be fine. No. No. Now it's workers. It's workers, workers, workers. If you have the workers, the jobs will come find you. It's as simple as that. It's a whole new world. And so you got to find workers. How do you find them? Well, you can make them in the old baby factory. That takes about 22 years and an ungodly amount of college funds, not to mention diapers, heartache, and various sorts of other painful things that kids bring to your lives. Or you can bring more in right now through fixing our immigration system. Or if you're domestic, you want to attract people to your state. So interstate mobility is going to mean a lot. Or you can try to get more out of your existing workforce. How do you do that? Well, you start figuring out, how do I get seniors to go work a part-time job? How do I encourage them to do that? Or even more importantly, how do I get women to work? Because participation rate for women in this economy is really low compared to other developed economies, mainly because we don't subsidize childcare at all. You know, say what you want about Biden's last bill, and you can point fingers and say what a communist and all that kind of stuff. I would tell you, if you told me 3 kinds of infrastructure, we could fix our highways, we could build a bunch more light rail in cities, or we can put a bunch of money into pre-K education, by far and away, the best economic payback, number 3, pre-K education. I mean, you want to help kids in low-income families, get them into school when they're 2 years old, right off the bat. The long run is huge. By the way, you help that family because you allow that mom to go get a job, which again, really helpful for the family. And now you can make a very concrete argument that this is really good for business because you've just added to your labor force. So, time to think a little differently, I guess is what I'm trying to say. I'm not a guy who would normally be up here espousing that particular issue, but it only makes sense in this particular world we're in right now. And of course, from a California perspective, here's your biggest problem right here, which is the fact that we still have we're in the top 10 states for, of course, net migration. That is to say, people moving out of California to other parts of the United States, Arizona, Idaho, places like that. Again, California, very similar sort of situation. The unemployed to job openings ratio says this is an incredibly tight labor market. You drive down any street in any part of California, you're going to see nothing but help wanted signs. But, of course, our payrolls are nowhere near where it was pre-pandemic. Here's kind of a breakdown of Los Angeles County. I just grabbed this as an example, but it's the same thing everywhere. Leisure and hospitality getting really hammered right now. Again, because these are the jobs that disappeared. And now that they're reopening, there's no one to hire because they've all gotten sucked up in other parts of the economy. But if you think about what's going on here in general in California, it's an interesting picture because, again, we continue to talk about unemployment rates, right? I mean, Orange County's unemployment, it's down to 5%, where LA, well, that's still at like 7% or 8% right now. Unemployment rates are completely irrelevant. It's the most useless statistic because I know for every single unemployed person, there's 3 jobs. It just doesn't matter, right? It's not a relevant statistic. It's not a relevant statistic. You might ask, well, why is this person staying unemployed? And the answer might be because I'm waiting for my business to reopen, or I'm waiting for the movie industry to get going so I can do my old job again, whatever I was doing. Or equivalently, I'm just waiting for a really good job offer. I got money in the bank. I don't need to take a job slopping dishes. I'm going to look for something that gives me career benefits and a ladder and everything else. We'll see. But, of course, if you didn't get hit hard in the first place, you're doing pretty well right now. And that's the key. Interesting, if you look across California and say who looks good from a jobs perspective, well, the places that didn't lose a lot of jobs in the first place. Stockton, only down 1% from pre-pandemic. Visalia, that's Tulare County, the Inland Empire, Fresno, Sacramento. The list of economic superstars in the state is not what I would call a traditional list, as the case may be. Near the bottom, East Bay, Santa Rosa, San Francisco, Los Angeles. Again, these places lost a lot of jobs, they lost a lot of labor force, and now they're struggling to get back. Now, the big problem in California, lack of labor force growth. Why don't we have labor force growth? I'm from Western New York originally. I will tell you, California's a lot nicer than Rochester, New York, particularly this time of year. I got a text from my sister yesterday showing me the 18 inches of snow they got in their backyard the night before, and I remembered all that. But people aren't moving from here to there because we don't have housing for them. I've talked about this before. We don't need to reiterate. Whether you're looking at housing units per capita or vacancy rates, no matter how you look at it, California is incredibly short of housing. Now, to be clear, it's not a housing affordability crisis. They love to call it in the state. We have an affordability crisis. Well, actually, housing isn't all that unaffordable here, at least not relative to the people who are living in it. And that's the key, right? Take, for example, this is worst states for housing affordability, who are using over a third of their income. Share-owned. In California, about 28% of homeowners are housing cost constrained, spending 30% or more, or 33%, a third of their income on that housing. That's a pretty high number, not as high as Hawaii, but only a little bit higher in Florida. But here's the number you really want to know. It went down by 12 percentage points over the last decade. So it's way lower now than it was a decade ago, despite the fact that you've had an enormous increase in home costs in California. How can that be? How can home costs have gone way up when we don't have an affordability crisis? Well, because the people buying that real estate are very high income. And that's the metric. You know, one of the worst metrics for affordability is comparing the price of a house relative to the income of people who live in that neighborhood. Why? Well, these people already live there. They don't need to buy a house. You really want to look at the price of the house relative to the income who want to live there. And that's the key. A lot of people want to live in Orange County, but when there's so few homes available, only high-income people win that bidding war. And by the way, they can afford that $2 million starter house just fine. Thank you very much. So it's not an affordability crisis, it's a supply crisis. And if you want to see that number, this is vintage housing stock here. Since 2000, it's not even that long ago. 2000 is not that long ago. Since 2000, Texas, 1/3 of all housing in Texas has been built since 2000. 1/3. 1/3 of all housing in Texas has been built in the last 2 decades. California, it's 15%. In the last decade, 14% there, 4.6% here. We don't build. You don't build, you can't grow. It's as simple as that. Not complicated. And when you think about Southern California, the Inland Empire has been the labor force of last resort. LA, Orange County, San Diego, just haven't built much at all. But the Inland Empire, they built a lot, and that's what's been fueling, if you will, labor job growth in the area. But the Inland Empire is not building housing right now. So now there's nobody anywhere in Southern California. In fact, this orange line, this blue line here, that's single-family permits in LA. LA is kind of building better housing now, but still below where it was in the peak. But look at yellow. That's Riverside. Riverside's building nothing. San Bernardino's building nothing. And Orange County continues to build nothing. So yeah, it's really hard to stock up on people. Now, according to the Department of Finance, we're going to have a bounce back in net migration, which I don't fully understand how they think it's going to occur without some sort of major change in building housing. In the meantime, this is what you got to worry about. Population in the state is growing 15 to 64. People 15 to 64. Department of Finance says no growth for the next 30 years in people in working age in California. Lots of new seniors. That's growing like crazy. Most of them, by the way, living in Newport Beach. All right? That's not a problem. But again, this is a problem. Now, is this a death knell for the California economy? No. Because remember, there's still a big shift going on. Even if people are moving, they're still out, people are still moving in. Whether they're coming from the rest of the world or they're coming from the rest of the United States. And for the most part, high-skilled, high-income people move in, and low-skilled, low-income people move out. So in other words, if you look at our labor force, Arizona, California versus Nevada, Arizona, Nevada have had a lot more people than we've had over the last 25 years, but output in California has been growing a lot faster than in Arizona or Nevada. So we are growing on the intensive margin. We have high-end industries that are expanding, doing well, but our low-end industries are moving, and they are moving out of state. I mean, Elon Musk went from the East Bay to Texas, not because of regulations and his frustration with the state government. Even though regulations and frustration with the state government were certainly part of the conversation, that's not why he moved. He moved for the very simple reason that you can't really assemble cars in a state that doesn't have car assemblers to hire. It's not complicated. Not complicated. Simple as that. So again, some industries, if you're high skilled, you will prosper. You can thrive. It's just a country club California situation. But lower end industries, particularly say, for example, manufacturing, are going to have a tough time continuing to thrive in this particular environment, whether or not we like it. Now, with all this good news, where's real estate? And of course, where does this whole thing go, right? Well, let's just talk about business investment right now. Business investment has bounced back. Overall, private fixed investment in the third quarter above where it was pre-pandemic. Profits are up. Proprietors' incomes are up. On net, again, this is in the aggregate. Yes, I understand some companies are suffering, but other companies are making money hand over fist. And as a result of that, lots of money, and of course, investments bouncing back. And investments bouncing back for stuff that's really important for California. Software, information processing equipment, research and development, even entertainment and literacy, which was way down, starting to come back. Stuff that drives this state is doing pretty well right now. One of the big surprises out there, particularly for those who are talking about the death knell of real estate, was a huge surge in overall residential sales and residential prices. New home sales, existing home sales went through the roof. Prices followed along quite quickly. Overall, home prices in the U.S. growing something on the order of almost 20% year over year. I mean, look at Phoenix, 28%. San Diego, 26%. Seattle, 24%. Giant numbers across the board. Here's some numbers from Southern California. Orange County just got into the million mark. Congratulations. You're now over $1 million median. You've joined Santa Clara County, now as the two most expensive counties in the state on that particular front, San Francisco. Even LA, though, coming up pretty strongly, as the case may be. What? Why? Who would happen, you know? Permits are starting to pick up, no doubt about it. New permits for single family popped, although it's come down again. It's interesting, if you're interested in the single family market, inventories for new homes for sale coming up just a bit, inventories for existing home for sale is way down. So what you really have here is an incredible amount of compression at the bottom end, people trying to get into the housing market. It's first-time buyers. Top end of the market is always building. There's always plenty at the top end of the market. It's the bottom end where you're seeing a lot of the compression, where you're seeing a lot of the strength at this particular point in time. And by the way, if you have development clients, townhouses is a great place to be right now because entry-level housing is in desperately short supply everywhere. Now, what happened? What is driving this? Well, some of it is the rebound from, of course, the Great Recession, what happened afterwards. Homeownership rates were starting to climb again, starting to move up, as the case may be. But that's more of a long-term circumstance. The short-run circumstance had a lot to do with the narratives about housing in 2019. Remember, 2019 was the year we all talked about a recession that never actually happened, a recession driven by interest rates, the trade war with China, collapsing real estate market, blah, blah, blah. As true as those things weren't in actuality, nevertheless, it was the narrative. And in 2019, as I went across and I did these speeches, I can't even tell you how many folks asked me the same question. So what, our home prices are going to fall? And it's almost laughable because, you know, if you go back to 2006, the mantra coming out of Wall Street was that home prices never fell. And at some level, that was also silly, but they had a point. If you looked at the data, you had to have an absolute calamity in residential real estate for prices to fall. It had to be a calamity for prices to actually fall because people hate to take losses on their homes. They would rather not sell. They would sit in a house they don't want for 2 years just to avoid selling it for less, right? So you get a big hit for liquidity. So obviously in 2019, home prices were going to fall, but everybody thought they were going to. And that's enough. Just that story, just that narrative meant people sat in the sidelines and waited, and as a result of that, the market was incredibly cold for no particular reason except for people said, we think prices are going to fall. Now, you get into 2020, and what happens? Well, we're all stuck at home. We're also thinking about that house, and then interest rates, which had gotten close to 5%, absolutely plummeted, some of the lowest they ever were. And of course, we have tons of money in our account because of the subsidies, because of my PPP loan, because we're not spending money the way we were last year. And everybody went out to buy a home, and what they found was a market that was already very inventory constrained. Suddenly, we went from, wow, I'm waiting for home prices to fall, to, wow, I will never be able to buy a house. And everybody started just going crazy and launching numbers at everything. Now, prices are through the roof because everybody's having these bidding wars. They couldn't keep up fast enough. I don't know how many people ended up like buying homes and then having to put extra cash in because the bank wouldn't even approve the amount they bought it for because the appraisals couldn't keep up with how crazy it was out there, right? Is it a bubble? No, it's not a bubble. Because a bubble says there's something fundamentally wrong with the market. What's wrong with this market? You got tons of equity in residential real estate right now, tons of equity, right? From an affordability standpoint, I already showed you the numbers. In 2011, 28% of Americans were housing cost constrained. 2019 was down to 19%. Credit markets, mortgage credit's never been cleaner. Even with all the refis, you're talking about 85% of borrowers having FICO scores above 750, right? This is 720. This is an incredibly clean market. So no, it's sustainable. It might not be reasonable or rational. If you compared, say, homes relative to renting, I think there's some imbalances forming there, which says that at some point in time, we're going to have to swing back. Prices are going to have to level off some. There's going to have to be some re-equilibration. But there's nothing fundamentally wrong in this market that would suggest a housing crash. Just at some point out there, things have to go really cold to let things catch up. As for apartments, the market got cold, but we never saw the massive wave of evictions. And then by the second half of last year, markets got super tight. Like second half of last year, people started moving again. And suddenly, vacancy rates started shooting down, asking rent started going up again, the apartment market turned the corner. Now, what happened to the 30, 40 million people who were going to get evicted, right? Because that was the story. Remember 30 to 40 million people? Pardon me for digressing for just a second to talk about the power of narratives and how crazy things can be. This is what happened. In the beginning of this, and I think it was in April of 2020, the census rolled out something, and they must have had it somewhere in the background ready for a circumstance like this, but they released something called the Pulse Survey. And they said, this is a crazy situation. We need fast data. Every 2 weeks, we're going to run a survey. We're going to ask people a bunch of questions about how they're doing. And that's great. I love data. I'm all about that. Now, in the middle of that survey, they asked a question which I had a few problems with. They asked people, are you having problems paying your rent? Now, why do I have a problem with that question? It's a little vague. When you say you're having problems paying your rent, what exactly does that mean? Does that mean I can't buy a prescription medication my child needs? Or does that mean I can't buy avocado toast and my latte every single morning of the week? I don't know what a problem is. But putting that to one side, 15% of people said at the beginning of that survey, I'm having trouble paying my rent. Now, to be clear, that's a baseline, 15%. And we want to watch that and see how it changes over time. Well, somebody from the Aspen Institute, does anybody know the Aspen Institute? You ever heard of those guys out of Colorado? Let me explain. There's two kinds of communist think tanks. There's the smart communists, like the Berkeley Labor Center. I fight them all the time. And they're completely off the rails, left-wing lunatics, but they're smart, and it's hard to deal with them. And then you have the Aspen Institute, which is the stupid communists. These people are, the stuff they do is so out to lunch, it's pathetic. I can't even watch. Somebody at the Aspen Institute took that 15%, multiplied it by the number of renters, came up with 35 million, released a press release saying because of COVID, 30 to 40 million people may be evicted. I'm not kidding. That's stupid. That became conventional wisdom in every state capital across this country. And almost every state passed eviction moratoriums. It became a federal priority to pass eviction moratoriums without a shred of credible evidence that that number was anything other than utter, total garbage based on a stupid analysis of a vague number. Yeah. That's the world we live in, right? The reality is, renters, we did some study for the California Apartment Association. Renters were in really good shape coming into the pandemic. Best shape they've been in a decade. Incomes were up. Their debt ratios were down. Their rent-to-income ratios were down. They were doing fine. And then the pandemic hit. Their average checking account balance over doubled. The bounce back in consumer spending for low-income families was faster than for high-income families. Not a shred of evidence that renters were suffering yet again. Even into last year, when these things were starting to fade, you kept seeing these scare stories of people being evicted. It's just nuts, but that's the world we live in. Simple as that. Now, as for commercial markets, well, look, if the probably most important statistic for commercial real estate I could show you is this one right here. This is commercial bank loan delinquencies in the commercial banking system. None. We had a little bit of a blip there. tiny little blip. But for the most part, commercial real estate loans have been super solid. Some issues in the asset-backed security markets, I know that, but it's such a small part of the market. They were making a big deal out of it. It's really quite small and constrained. Lending markets is easier to borrow. Year-on-year growth, though, still relatively weak. But this is from data from Wells Fargo, Real Capital Analytics. Commercial transactions came back, and perhaps even more succinctly, more importantly, cap rates by property type have continued to go down. Doesn't matter. Doesn't matter if it's apartments, office, industrial, cap rates are going down. Now, that's not, of course, a very good story. Because when you think about commercial real estate, it is a time of flux. It is a time of change. And there's little doubt that COVID has hastened those changes, those shifts, things we have to pay attention to. For example, some of the big trends coming into this pandemic. We know, for example, that investments in multi-merchandise shopping have been going down because people are buying stuff online and malls are trying to reinvent themselves and all this kind of stuff. Whereas, of course, industrial has become the golden child for all sorts of reasons, distribution, logistics, whatever the situation may be. They're doing just great. What's been really interesting is the enormous investments in office, despite the fact that office vacancies never really went down much after the Great Recession. But even though office vacancies weren't down, you saw these giant, brand new, beautiful towers going up across all these downtowns, not the least of which, of course, is San Francisco, which built some huge ones. You go to right around here, right? Now, what sort of actually happened out there? We know cap rates are okay, but permits are down. They fell pretty sharply in LA County. Permits are down in Orange County. So at least from a construction standpoint, people are still trying to figure out what's what. But from a transaction sales standpoint, from a swap standpoint, consumers seem pretty confident. What do we make of all this? Well, there's a lot of data here, but I want to focus on one, which is the vacancy rates at the far right-hand side. I think these are 2 years. I'm not sure these are 1 year. I'll have to go take a look, but it doesn't matter. What's really important here is three things. Warehousing, vacancy rates are down across the board. If you're in the industrial space, you're loving life right now, right? Even the Inland Empire, which looked like they may have been overbuilding with all the tilt-ups they were putting up across the board, boom, suddenly those things are getting filled up, right? Beautiful. Retail, surprisingly quiet. Surprisingly quiet, despite the fact that we know that there's issues out there, particularly for some of the small sort of B-rate kind of stuff, right? And then office, well, the two scariest numbers here, Los Angeles, Orange County, look at the big increase in vacancy rates for offices. And by the way, this doesn't even capture, of course, the shadow space, which we know is popping up all over the place. So office, something's going on. Industrial, proving its worth. Retail, surprisingly quiet. How does this all shake out? Well, from a retail perspective, look, yes, a bunch of sales are going online. They have been anyway. Pandemic hits, and of course, a lot more goes to online sales. And look, Jeff Bezos, when he gets your grandma to start buying toilet paper from him, she's not going to stop, okay? So they've accelerated the trend. The de-retailing is going on. But right now, retailers, even brick and mortar, are doing well. This is retail sales minus the non-store retailers. This number is still high. So yeah, the brick and mortar guys are actually doing pretty well right now because of excessive consumer spending. So that's keeping things balanced. Plus, there's still even some of the commercial eviction moratoriums, and people are still trying to figure it out. There's still more shakeout in the retail land. We know that. But in general, right now they're doing okay. But again, there's not really any news here. We know people are buying stuff online. We know that JCPenney's and Sears are dead, and you need to find health clinics or gyms or whatever to cap your mall. We get that. It's the brave new world of retail. It's going to go back there. And you need to take a look at the retail employment numbers. You know, it's interesting. Clothing, way down. Electronics, way down. Furniture, surprisingly down. Motors, because there's no cars. But building materials, food and beverage, general merchandise, surprisingly strong right now. Non-store retailers, of course, way up as well. So some parts of retail continue to thrive. You just got to find the right place. As for industrial, this, again, I breezed right by it, and I meant to stop for a second and show you that. I don't know if anybody caught it earlier when I was talking about the dichotomy of this recovery. One of the numbers that's most amazing to me is looking at taxable sales coming out of San Francisco versus Stockton. 5 years ago, taxable sales in Stockton were about 65% of what they were in San Francisco County. Now San Francisco County is 65% of Stockton. It's completely switched. Completely switched. And that's because global tourists aren't going to San Francisco. And of course, a lot of people aren't going into their job in San Francisco and buying stuff at lunchtime. And at the same time, everybody in the Bay Area is buying stuff out of all those warehouses in Tracy, which can't be built fast enough and can't hire people fast enough, right? Look at Riverside's taxable sales compared to LA and Orange County, right? LA and California, sorry, this is LA, California. Yeah, they're coming back some, but look at Riverside, it's through the roof. Again, the warehouses out there are just doing crazy. So the inland parts of the state are just on fire. They've got more money than they know what to do with. In fact, it's going to be really interesting in a year or two. I didn't really think about this because I was dealing with some bond investors who were doing some rebonding for San Bernardino County. And their question is, so when is Sacramento going to change how taxable sales are allocated to where people live rather than the warehouse they're buying out of? Which is interesting because, of course, 5 years ago, Riverside was screaming that Santa Monica and Beverly Hills was getting all the taxable sales. Now Beverly Hills and Santa Monica are screaming that Riverside's getting all the taxable sales. That's the new world we live in right now, so let's see. The biggest issue is average hourly wage logistics and just hiring people to work in your factory and in your place. These are the biggest issues. Now, as for office, work from home. Work from home. I came in very quiet here today. You guys have a bunch of your folks working from home, right? We were talking about this. We changed offices in the middle of this. We moved from my place where I had to a new place. No one even knew because I haven't had people in my office for a year and a half. We're just now starting to start rolling them in the next couple of weeks. It's a whole brave new world. We get it. People have learned to work remote. And it's interesting because remote working has always been a potential, but it hasn't really taken off. Why? Culture. Simple as that, right? I think of the company we had work from home. For the most part, it didn't work. But from a managerial standpoint, we just kind of said, okay, work from home, we'll see what happens, and it didn't really work, and we never really investigated. Now everybody has to work from home. Now we got to figure this out. So we started doing daily calls, and then it became twice a week calls. And then we invested in Slack and made sure everybody had good internet connections. And we started building electronic ways of making sure people were keeping up. And lo and behold, it worked. My company's been working pretty well for the last year and a half. Now, it's not all great. I can tell you, it's really hard to do training. Sales, you need a nice space to do sales. And probably the worst thing of all is camaraderie. Not having an office is horrible. I have terrible turnover right now. And part of it is, everybody feels like a contractor. Everybody just feels like a gig worker. There's no emotion. There's no camaraderie. I don't know who these people are. I don't see them. You got to have people in the office. People want to be in the office. But at the same time, they're not going to want to come to the office all the time. And now the systems are in place. The culture's there. We know we're going to have to work with them. In fact, this is a data that came from the Atlanta Fed. They did a survey, and this is the category. This is office jobs. According to the survey of human resource managers and surveys, prior to the pandemic, 10% of office jobs were work from home. Post-pandemic, 30% of days are going to be work from home. That's pretty simple. That suggests, in general, most companies can shrink their footprint 15 to 20%. That's a big number. And it's not as if some companies are going to be all virtual and some people are going to be all offices. You're going to have to deal with this, which is that a 30-year workforce never want to work from home, and a 30-year workforce always wants to work from home. And what's even interesting about this, it was, my joke on this for the longest time, because I love this survey. Oh, you want to work? You never want to work from home? Oh, you must have kids. Exact opposite. People who have kids want to work from home. That's how you manage your kids' lives. Single people want to work in the office. They don't want to work in their home. Simple as that, right? So, yeah, if you're going to compete, if you're going to have workers at every stage of their lives, you're going to have to offer a hybrid system. It's as simple as that. What does this mean? What does this mean for office space? Well, let's start with a very simple comment. A little straight. How am I doing on time? I don't want to. Oh, 3:40. What we got? 15 minutes? Yeah. That's good, because it gives me time to talk about the depression we're going to have. Oh, I didn't talk about that, did I? We'll come to that in a second. So y'all woke up there, right? Look, it's very simple. Downtowns exist for a reason. Huh? Downtowns, they exist. They're expensive. They're expensive to rent, expensive to park, expensive to eat, expensive to get to, yet they exist. Well, look, if businesses are willing to take on all these expenses to be in a dense job zone, there must be a value to it. And there is. All right? That's the whole idea. Economists have gone through, they talk about external economies of scale. You are more productive. A law firm is more productive operating here in expensive Irvine than they would be if they got an office in Blythe. Even though Blythe is a lot cheaper, they're here. So, why? Access to liquid labor markets. There's the sales panache. There is, you're close to your clients, whatever it is. These places exist. Now imagine for a second that every office renter right now shrunk their office space by 15%. Everybody across the board shrunk by 15%. What's going to happen to downtowns? Well, they're going to become cheaper, right? But the value of being downtown still exists. So that means, in theory, people are going to start moving downtown. So downtowns are going to be in an interesting position because they are going to have more jobs and fewer people, as bizarre as that sounds. Because more jobs are going to be listed as being downtown, but according to that data, 30% of those jobs are going to be occupied by people who are working out of their home on any particular day. So more jobs, fewer people. Downtowns aren't going to go anywhere. In fact, I would argue they're going to become more important. They're going to become a more dominant source of employment and business formation. But again, a lot of those people who are working downtown are actually going to be in their house 2, 3, 4, maybe 5 days a week. So we're going to have more concentration of jobs in companies and more dispersion of workers. It's going to be a strange, interesting world. What it means, of course, is suburban office space is screwed. Now, they were screwed 5 years ago, but now they're quadruple screwed. The suburban office space is going to get massacred. Different client, different time. There's a big hunk of land in Contra Costa County, an old weapon station. They are now decommissioning, and they're going to turn it into a big zone. And, of course, the good folks at Contra Costa County want this to be their own Silicon Valley. To which you have to point out to them that if you put offices here, they will never be occupied. You're wasting your money. They will never be occupied. The only thing you want to put in this space is housing and industrial. That's it. You're wasting your money otherwise. They're not hearing us, but this is the reality of how this thing shakes out. And the market is still trying to figure it out, still trying to figure it all out. Now, where is the problems? Where are the issues? Well, let's talk about banks. Bank lending is, like I told you, they have a big issue there. They're trying to expand their portfolios. They're competing like crazy. They have no problems. This is interesting. This is C&I, commercial industrial loans. You can see how clean the numbers are. Again, but hard to make loans. Why? Look at cash on hand for non-finance corporations. It's not just households that have cash. Everybody has cash. So yeah, the lending market is competitive right now, and you'll see it, for example, in the C&I space. Excuse me, I said C&L, C&I space. For example, this is net percent of domestic response stronger demand. No one's really seeing stronger demand for C&I loans. Everybody's got money. They don't need C&I loans. However, these guys have cash on hand. So what are they doing? They're shrinking their spreads, and they're getting rid of, getting rid of covenants. So they're willing to make more loans with lower spreads, with fewer conditions, because of a competitive market. This should be wonderful to hear if you're an investor. But what kind of risks? Where are the problems? Well, let's start with this one, federal debt accumulation. Since 2014, this nation's picked up, $10 trillion of new debt. $10 trillion. By the way, if you go back to 2000, the last 20 years, we've gone from about 60% debt to GDP to 125% debt to GDP in 20 years. 20 years. Enormous expansion. And, we already have a budget problem because of boomers retiring. We should be trying to fix our debt problems, and instead, they just can't borrow fast enough. There seems to be no limits, in part because there's no political consequences for it. The Democrats think debt's irrelevant because you could have modern monetary economics, which, by the way, would be the greatest catastrophe on the face of the planet from a monetary perspective. And as for the Republicans, I'm sorry, but they completely undermine any authority they had when they agreed to $1 trillion structural deficit under Trump pre-COVID. $1 trillion, structural, in the 11th year of an expansion. Republicans signed up for, sounds good to me. What? What happened to fiscal conservancy? Doesn't exist, right? Nobody pays any attention. So, yeah, public sector debt hasn't picked up too much, but federal debt's going through the roof right now. And again, they haven't even come close to fixing the problems. Even through the third quarter, the structural gaps are still there. Even if they turn off all the stimulus, we have $1 trillion plus structural deficit that they're not even discussing. How long can this go? I don't know. Never has the largest country in the world gone so fiscally crazy. I mean, we're behaving like Greece or Italy, not the most important economy in the world. Very strange circumstances. And of course, Mr. Powell with his $4 trillion, low interest rates. Again, why? I mean, Janet Yellen, Ben Bernanke, they were fighting a collapse in household wealth, not one of the greatest expansions in household wealth we've ever seen. They were fighting massive problems in the banking system, not a banking system that looks spotlessly clean. They were fighting, they were fighting all sorts of problems, a banking system tilting towards complete insolvency. He's not fighting any of this. So when you put tons of money in the economy and the economy doesn't need it, what happens? It's called inflation. 7% at the end of last year. 7%. Greatest year in 40 years. What's amazing is inflation expectations haven't budged. This is the craziest part about this entire conversation. You've never seen the money supply grow like this. Inflation expectations haven't budged. Bond market, we're fine. Yeah, 5% negative return, so what? Again, I for the life of me, I cannot sit here and look at this and go, how is this reasonable? But it's all the power in the narrative. Remember, what has he said, right? He said all along, it's transitory, it's transitory, it's transitory, right? It's no big deal, just because the supply changed. So the bond market, made up of a bunch of people whose job is not to truly worry about the long-run structural stability of your investment, but just basically placing the billions of dollars they have to place, they just go, okay, well, Jerome Powell said it's okay, and I'm going to continue to buy treasuries. For how long? I mean, they're just now starting to talk, oh, maybe we're going to tackle inflation. We might have 3 interest rate hikes this year. Oh, okay, everything's fine then. No. If you sat down and you did a basic sort of structural model of inflation, trying to explain it, it's hard, don't get me wrong. It's hard to figure out inflation. If you go back to the big inflation surges in the 70s, it's a combination of things that set it off. Yes, it was a lot of money, but it was also a lot of demand. And it was obviously a big increase in commodity prices. And it was a Federal Reserve that was just kind of unconscious about it. And they had big deficits at the federal government too. In other words, everything that happened in the 70s is happening right now. And if you've done a simple model, if he does 4 rate hikes next year, but doesn't touch the $4 trillion in quantitative easing, we're going to have another 7% inflation. Easy. Could be more if it starts heating up. Easy 7% inflation over the course of the next year. Tightening the federal funds rate doesn't do anything. Maybe it cools off the financial markets a little, because it will push interest rates up a little bit. But the only way you're really going to get inflation to go away is, of course, through an enormous increase in interest rates, which would happen when and if the bond markets actually say, we have a problem here, and we're not willing to accept negative returns. When does that happen? I don't know. I can't possibly know. It's a $1 trillion question. But we've never seen a bond market act this brazenly, completely unconcerned about what is clearly the greatest inflationary pressures this nation has seen in 50, if not more than 50 years. Here's my favorite tweet that came out over the last couple days here. Fed's Bullard, monetary and fiscal assistance provided in response to the pandemic may have been excessive. Couldn't have said it better myself. So, how does this shake out? Where does this go? Again, look at the unit money supply, the amount of money divided by GDP. This goes back to 1959. We've never seen anything like this. It's not reasonable, it's not rational. And yes, inflation is going to stay here for a while. When does it break? I don't know. But a couple Fed hikes is not going to change this equilibrium. It's the bond market finally saying enough is enough. And I do not know when that's going to happen. What I really know that scares me, though, all has to do with this interaction right here. Because it's not just that interest rates go up. We're in a cash-driven world, right? Interest rates going up a little bit is not going to change things. What's really going to hammer us is when you have to really jack those rates up, make borrowing expensive, and if something else happens to the economy. What else happens to the economy? Well, you need a big downshift in demand. Where could that come from? One of two places. First of all, interest rates come up, the stock market bubble pops. Home prices stop growing. For some reason, household net worth suddenly starts retracting. Maybe it goes flat, maybe it comes down just a little bit. But the real problem is going to be when the federal government finally has to acknowledge it. Because remember the big problem you're dealing with here. The federal government has gotten away with doubling the debt to GDP ratio of the last 20 years because interest rates have gone down, 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 right? They've basically run the biggest bull market in the history of bonds, and they have quietly blown all the doors off of federal borrowing under the guise of the fact that, hey, look, our borrowing costs are still only 2.3% of GDP. They haven't budged. Everything's fine. What happens if bond rates go from, 1% to 4% or 5%? It's not that high. 10-year bond at 5%. What happens to the cost of debt? It goes through the roof, on top of the $1 trillion deficit we already have. Now, borrowing goes through the roof just because they have to finance past borrowing. And then you get into this nasty, vicious cycle. When does it end? I don't know. But the interaction here could be very ugly. I'm not willing to lend you money because I don't know how you're going to figure this out. You have to cut more. You're not, which means I'm going to charge you more, which means these expenses are going up and are pushing out other things until, again, we end up like a Greece-type situation where we're in a desperate circumstance. How does it shake out? I don't know. But think of this. When will housing turn? Okay? Well, I sat down and did some affordability numbers. I looked at percent annual income necessary to support mortgage taxes at different interest rates. If mortgage rates stayed current, nice and affordable. 4%, 5%, we can handle that. 7%, now housing gets unaffordable. 7% mortgage rates. There's a few gray hairs in the room. Remember what mortgage rates were in, 1985? Yeah, at the beginning of the 80s. By 1985, down to about 10%. That's not that high. Yeah. So something is going to hit out there. When, why, how, what? Beautiful part of my job is you have to keep inviting me back every year. Maybe every 6 months, to be honest with you. We might have to do a mid-year on this. Because it's crazy. Again, the world is not behaving in normal ways. And like I said, this is so similar to how I felt in 2005 and 6. In 2005 and 6, I'm like, the world is not normal. This is not right. My spidey sense is going crazy. And by 2008, we started to see what happened when the house of cards started falling. We are in a similar place. The risk has moved from the private to the public sector, but the risks are just as profound. Not in the short run. Look, the V was the only logical outcome. The V is back. The only reason the economy is hampered at all is because supply can't keep up with demand. That's the only reason we haven't caught up even faster. Plenty of pent-up demand. $29 trillion in new household net worth that people are desperately trying to spend. Labor markets are tight, and they're going to stay tight. Incomes are going to continue to rise. You're worried about low-skilled folks. Again, your market-level solution has arrived. On the other side of it, if you are worried about running a business, everything nowadays has got to be about productivity enhancements. How do I get more out of my people? It's as simple as that, everything. 2 years ago, we were terrified of the robots, remember? The Luddites were attacking again. AI is going to steal our jobs. Bring on the AI, people, all right? We desperately need it. As for the outlook, probably going to have 6%, 6.5% for Q4. I would imagine that growth over the course of this year could easily be 3.5% to 4% per quarter, easy. Unemployment, 3.4% by year end, deal, I can see that happening. But it's not sustainable. It's all built on $11 trillion and counting of stimulus. The way to think about it is very simple. Right now, this rocket's going up, and we're all riding it. And if you're in the market, the music's playing, you got to dance. Simple as that. You got to be out there dancing. But I keep telling everybody, don't get far from your bunker. Don't get overexcited. It cannot last. At some point, the boosters on this rocket are going to run out of fuel. And then the question is how hard are we going to land? 3 scenarios. Dramatic Fed action right now. Inflation heats up. People get serious about it. The administration's worried about it. Bam, they stomp on the brakes. They crank it up. They get rid of quantitative easing. Yeah, you slow down the economy hard right now. Maybe you bust the market. Maybe you even have a couple of quarters where, God forbid, we lost a few jobs. Best case scenario, because then we work it out of the system, maybe not even a technical recession before we get on to the next expansion. Number 2, goes a little longer. Consumer spending, all that pent-up demand drives us right through that next stage. But now, consumers are spending way too much on the basis of wealth that, again, doesn't really exist. Now, when we hit ground, it's a little bit more painful because not only are you dealing with the public sector consequences, but you're dealing with the consumer spending drop as well. Third case scenario is this thing goes on for 4 or 5 years. And now it's not just consumers getting into it, but businesses are getting into it. We've had a very conservative cycle for the most part. Not a lot of excessive investments. People have been relatively cautious. But for how long? You saw the venture capital numbers. I mean, listen, we went from $100 billion to $250 billion of venture capital investments in 2 years. I'm sorry, there aren't that many good ideas out there. Now they're building buildings they shouldn't be building. They're buying machines they shouldn't be buying. Now they're borrowing money like crazy. Boom, it blows up. Now you got a depression. Because you have all the problems of the private sector combined with all the problems I've already described in the public sector. Where does this go? My gut feeling is somewhere between 1 and 2. That somewhere out there we're going to hit, it's going to be painful, but we'll probably manage to get through it, as long as we get on top of it relatively quickly. I don't know. I just don't know. Again, the level of uncertainty right now is tremendous. How many years have I been talking for Voit now, on and off? Or maybe more than that. I was 12, on and off, right? Yeah. Look, if I go back to, say, my 2017 or 2018 speech for you guys, it was kind of fun. We had a good time. We had some drinks. But for the most part, I was bored of my talk. Things were pretty stable, and the answer was, it's fine. It's fine. That's the answer. Whatever. And the other stuff, whether we grow at 2.4% or 2.2%, completely irrelevant. It's fine. That was the answer. Right now, I'm clearing the table. There's no more I know. All right? This thing can go a lot of different directions, but you got to keep in the back of your mind the simple fact that it is not sustainable. Period. How it shakes out, we're going to find out. So, you were all really quiet at the end there, which is exactly my intended effect. But again, right now, you got to play. You got to play. You can't sit on cash, not in an inflationary environment. So, but you got to be cautious. Simple as that. Caution. Questions, comments, thoughts?
I got a question on the Fed controls the short-term rates, obviously.
Yeah.
Federal funds rate, prime rate, short-term. Next companies, the bond is more affecting our part of the world, long-term interest rates with commercial real estate? I mean, how do you see that if the Fed starts to take action in the next 3 quarters? How do you see that affecting the long-term rates, or is it even going to affect the long-term rates?
Well, long-term rates are getting a little worried, right? You're starting to see the 10-year bond slowly drift up a little bit,
Like
very
the
low.
markets, they start
Yeah,
feeling it, right?
yeah. So, but let's go to the question is really on the short end of the curve, right, which is pushing up the federal funds
Short
rate.
end, but does it in any way affect the long-term?
No, it doesn't, because again, I go back to the idea that we live in a cash-driven world. Right? This is not a credit-driven world. People are not borrowing. Companies are sitting on tons of cash. Investors are sitting on tons of cash. Households are sitting on tons of cash. People are trying to figure out what to do with their cash. Interest rates are not driving the show for them. They're just not.
So how do we eventually?
Well, that's just it. Not until those long-run rates go up. Not until the long-run rates start getting absorbed into business investment, and suddenly things aren't penciling out anymore. Sorry, I can't make that pencil out with a 7% inflation rate, or I'm sorry, 7% interest rate or 8% interest rate. That's when things start getting interesting. So it's the long end of the curve that has to move. You're exactly right. Short end of the curve is irrelevant right now. So I don't even care about that.
So the countercyclical policy of the Fed, although it's
You got to.
they're maybe doing, that's not going to affect long.
You got to get rid. You got to undo quantitative easing. They're going to have to start selling off those bonds and sucking up the cash in that market, and that's when you're going to see long run rates really jerk. Yes, sir.
Hey, Chris, can you repeat the questions? I don't think
Oh, sure.
the audience
Yeah,
can
yeah.
hear, or certainly the people.
That's a great point. I'll start. I will do that absolutely for sure.
So in 2008, we had Wall Street get really complicated and cause a lot of trouble for themselves.
Yeah.
Being complicated with debt and insurance and
Yep.
swaps and all of that
Yep.
stuff that they didn't even understand what they were really doing to
Yep.
themselves. All unwound when interest rates started to pop. Is Wall Street doing that right now?
Right.
I gotta assume they are.
Yes and no.
They have,
Look.
they have more equity this
Yeah.
time.
So the question is about Wall Street. If this thing starts falling apart, are we going to see a Wall Street crisis on par with what we saw in 2008 and 9, where the pipes were frozen up and nobody was lending overnight and investment banks were going belly up and all sorts of craziness was going on in there? I do not see that happening now. Because again, at least not in ways I have seen, I have not seen Wall Street doing the same sort of stuff they did last time around. In large part because, remember, people kind of wised up a little bit last time. A lot of people got absolutely hammered by Wall Street because they got sold a bunch of garbage. I'd like to think investors are a little smarter now than that, right? They're not jumping into the asset-backed security market. They don't think that subprime credit is gold-plated AAA debt. They just don't, right? So they've kind of moved beyond that. They've gotten some control over the derivative markets. To your point, look, there's still a lot of complexity out there, and this thing got ugly enough. Yeah, I think it's going to have some profound impact on Wall Street, which could cascade through to the banking system. But that's not the center of it. The center of it is about the Federal Reserve and inflation, and it's about that government, that massive government deficit we're dealing with in Washington, D.C., that they honestly don't seem to think there are any functional limits to how much they can borrow. And to be clear, bond markets haven't told them anything else. It's not just domestic investors. You know, the real swing debt buyer could very well be foreigners. Remember, the big offset here, one of the underappreciated metrics of economic overstimulation is the trade deficit. The trade deficit prior to the Great Recession got to 6% of GDP. Never in the history of the United States, well, not in the last 60 years, have we had a trade deficit 6% of GDP. That was not normal, you know? You could tell the economy was out of control. It is now 4% of GDP and growing rapidly. Now, what does that mean? That means we're consuming a bunch of stuff from overseas, and by the way, they are more or less lending that to us somehow or other. They're buying assets, whether they're coming here and buying stocks or buying treasuries or buying factories, they are buying assets in the U.S. economy.
But that, to be fair, I mean, that's the capital account deficit, right? We buy baskets from China. They pay us with dollars, and then with our dollars, they have to buy financial.
Oh, sure. Sure. But in general, there is a basic equilibrium. If we have a trade deficit that's 4% of GDP, that means somehow or other foreigners claimed assets in the United States equivalent to 4% of GDP. Now, what is that? What do they buy? How do they end up with it? I don't know. Could be liquid, it could be illiquid. Completely agree with you. But what happens when investors are no longer will trust the United States? Well, the first place you're going to see is the dollar. Dollar's going to look what's happening in lira right now. It's getting hammered. I'm sorry, the Turkish lira, let me be clear. Right? So the dollar falling is a sign that foreign investors are getting nervous. And that could cause some problems, some ripples in this particular thing as well. Maybe this problem starts overseas, not domestically. I don't know. But can foreigners really walk away from the U.S.? We are the financial capital of the world. I don't know. I know. You're like, guys, you're the economist, dude. But what I have to convince you of, and this is what I'm trying to get across to you, is the unknowns are enormous. And when the risk is so large and so vague, people with certainty, even if it's completely unfounded, those are the messages you're going to hear out there. And when I'm saying the words to you, I don't know, trust me, I'm a guy who has a lot of opinions. If I'm telling you I don't know, you should be a little afraid about that. Okay? And I appreciate, well, that's not very certain, Chris. I know. That's why I'm worried. And when Jerome Powell gets up there and says, oh, inflation's not a big deal, I want to scream, you're a lawyer. You don't know jack about what you're talking about. And you have no business running the Federal Reserve. The whole reason we took the Federal Reserve and we separated it from government is to keep it from buying into political narratives. Forget all this, oh, we don't want politicians printing money. Okay, I get all that. But it's deeper than that. Politicians chase narratives. They have to. Look, I had a conversation with a guy one time, where a guy in our state government, right, who's a Democrat, but he's involved with an institution, and I met him, and he's a bright guy, and we sat down, we went out, we had whiskey, we had scotch at downtown. I was bonding with this guy. And I said, okay, I'm here, I'm drunk, I'm going to be honest. What the hell are you doing with this policy? It's stupid. And he looked at me and he said, yeah, that's nice, Chris. He said, let's say I agree with you, and tomorrow I change my tune. What's going to happen? I'm going to lose my job. Someone else is going to get elected. I have to listen to that narrative. And that's the narrative I'm listening to, because that narrative gets me my job back. All right? The whole point of giving the Federal Reserve, taking the Federal Reserve away from politicians and giving it to technocrats is to avoid that problem. Until, of course, we got a bunch of politicians to run the Federal Reserve, in which case we just attach ourselves to that problem. And now the Federal Reserve is no more than another political beast in Washington, D.C., and it's doing monumentally stupid things. And again, it's a completely undiscussed dynamic in policymaking in the United States right now. I'm amazed, but there's this whole thing. You can't, even Alan Greenspan, briefly, there was one point in time where Greenspan even said, this doesn't look right to me, it looked kind of inflationary, and then he got quiet, because you're not supposed to say anything. Really? Silence until depression? That's the world we live in? Sorry, I got a little bit on my pulpit there, I appreciate. Yeah. Do we have any questions online you want to read? No? All right. I'm not sure anybody's even out there, but maybe they'll watch this afterwards. Yeah.
Okay, the Fed, what's the right thing? Tear off the Band-Aid.
Tear off the Band-Aid. You need to sell those. You need to get cash out of the system. You start selling bonds and taking cash out of the market. Yeah, it's going to hurt. Interest rates are going to go up hard. The housing market's going to hard. Stock market's going to right. Cash is going to get erased. And suddenly, venture capital guys are not going to be able to get all the cash they want. Yeah, it's going to be ugly. It's going to be hard. But that's the solution. Do it now before this cascades out of control. Because when the private sector starts following the public sector, now you got a real problem in your hand.
And they're not doing it because it's not politically correct.
All right, well, then question about the other risks we have in the world right now. Russia maybe starting some small war in Ukraine and China. Are they going to invade Taiwan? That's not an economic thing.
They're there. They're problems. I'm not a global political
Either
expert.
one of those would be bad for the economy, though. Correct? 'Cause people-
Wars aren't necessarily bad for economies. I mean, it would be bad to go to war with China. Needless to say, our economy is intertwined with theirs. No one wants that. And I don't think Russia wants to start. They went in Afghanistan and got their butts handed to them. Okay, maybe they'll take Ukraine out, and then what? Then every Ukrainian freedom fighter we're going to be giving them rockets to shoot down Russian helicopters. How long does that last till they realize it's a disaster? The reality is what's that?
Russia's economy is also smaller than Australia. It's a relatively small, insulated economy.
Yeah.
Right? So it's not like Russia getting into a conflict with someone is like the U.S. or China, and you're like, oh my God, a third of the.
Oh no, I appreciate that. I mean, yeah, Russia is a yes, it's a small economy with large nuclear weapons. So you still have to pay attention to them. But again, to that point, he can't afford a war. Yeah, he'd take over Ukraine really quick. There's no doubt about it. But the real question is how long can you actually occupy it? Well, how pissed off are Ukrainians going to be? It's interesting. I just read completely off the topic, but kind of in this vein. I just read a book about a guy who fought through World War II in the Germans. It was a great book. It's called Panzer Commander. And he was a guy who was in the German military ahead of time and actually was doing exercises with other militaries. Then was fighting against his friends he had made on these exercises. And they took over France in like 6 weeks, mainly because the French just put down their arms and said, okay, we don't want to fight. And even though the French had really good weapons and a pretty good army, they just weren't willing to fight. Russians had nothing except for the fact they weren't willing to give up. And what you learn really quick is, yeah, okay, we just killed 1 million Russians, and guess what? There's another million behind them willing to die. You can't win this war. You can't win this war. Well, again, if they actually invaded Ukraine, which is millions of pissed off people, they're not going to win that. What are they going to accomplish? They're going to bankrupt themselves. They're going to get hammered. They can't do it. So it's all strategic. It's nibbles and bites. It's just saber rattling to improve his position. He can't do this, not in this day and age. I mean, look what happened to us in Afghanistan. Us in Afghanistan, for God's sake. You can't do it. Different world.
I had lunch today with a guy who started business in China, manufacturing, 1995. And he was talking about China really getting in and controlling. They have a long-term vision and they get in and control. We're getting out of Afghanistan, they're going in for the rare metals that are.
China scares me way more than Russia does.
Yeah.
But at the same time, again, it seems like America's finally woken up to that. Listen, these last two administrations, this administration before and this administration clearly don't get along. And if anybody missed that, Biden's speech on January 6th pretty much took the gloves off on that front, right? Fine. But the one thing Biden hasn't reversed was Trump's policy on China. So I don't have a lot of nice things to say about our former president. But when it comes to China, I give him a lot of credit because he actually was the first guy to stand up in corporate America and go, screw you, these guys are bad. We're not playing this game anymore. And be a good guy like Trump to actually make that decision, which is the right decision to make. And we're sticking with it, and we should continue to stick with it. And I'd still be putting more pressure on him. I'd put more tariffs on him. Squeeze them in every place you can. Because if we haven't figured it out, they're not on our side. They haven't turned into nice people.
Well, China's experiencing the same thing, labor shortages because of.
Oh, and they have demographic declines and everything else, yeah. And there's a reason for them to start batting down the hatches because there's a lot of angry Chinese people because they're starting to realize that they're getting shafted. You think income inequality here is bad. So, yes, sir.
You talked about the economy being flush with money.
Yeah.
I was reading an article that Wall Street is buying up residential houses.
Yeah, I went through that slide. I've heard this too. We have data from the American Community Survey on single-family rentals, right? Which is my best mode of this. Single-family rentals took off like crazy about 2009 because that's when everybody started buying foreclosures and renting them out. They peaked about 2012, and then from 2012 to 2019, they came down sharply. So we've been selling off single-family homes in ownership, not the other way around. So from my perspective, that story is just complete crap, complete crud, at least through 2019. Now, what's happened in the last 2 years, maybe something has shifted on that front that I'm missing. But to your point, I'll tell you, pre-COVID, I had a journalist come here from Germany, I think it was, and they were doing a big story about how Wall Street was buying all the single-family homes in the United States. And I'm like, well, that's nice, but I'm sorry to tell you, you kind of wasted your flight from Germany because the data says something different. And she was completely flabbergasted. She just couldn't believe. She's like, is this right? Is this right? It's the best data we have. So this story's been floating around for a while. I don't think it's true. I think it's garbage. I think it's Liz Warren garbage, you know. Not to be confused with Heritage Foundation garbage. Just want to be equal opportunity insulter here. But it's garbage. Yeah. So. All right. Well, listen. Like I said, enjoyed being here, even in a smaller framework, as the case may be, and you know, I look forward to seeing you in person next year.